Hi everybody, it's AJ speaking. Today I want to discuss the Rivian investment case. Today is Monday. Just a few days ago on Thursday, Rivian reported after hours 4Q results. With 4Q results, management provided significant disclosure changes. There's a completely new segmental reporting. Plus, management provided more comprehensive 2025 guidance, plus also dropped some hints about 2026. As some of you might know, 2026 is a crucial year for Rivian. And as the reason is Rivian is about to launch its mass market, truly mass market product, a SUV, the R2, which will play in the Tesla Model Y segment. And this analysis is about quantifying what this could mean for Rivian. So on this first page, I just wanted to go through some of the key items. And you can see here the last two actually reported years, 2023, 2024, and then a forecast for 2025, 2026, and 2027. The key observation about this forecast is that, first of all, in terms of deliveries, 2025 will be basically flat optimistically, or slightly below 2024's deliveries volume, with significant 2026 sequential growth, or I should say year-on-year growth, to almost 79,000 vehicles, and that is driven by the launch of the R2 platform, which in this analysis assumes a 2Q 2026 launch, and then with further significant volume increases in 2027, driven by further successful ramping of the R2 platform. And then secondly, so quick word on Rivian's new disclosure. So Rivian now splits revenues out into automotive and then into software and services, S&S. This forecast also splits out credits, because credits is a quite important topic. As some of you know, there's a meaningful risk that the new US administrations might affect credit sales in a negative way. They might go away to a significant degree. But in this forecast, we assume latest management guidance, which is pointing towards 300 million in 2025, and then assume some growth, and we will touch on the growth assumptions later when we get to this line item. So the forecast splits out credits, first of all, because it's disclosed, and secondly, it provides a clearer picture of the auto business, and also allows investors to more easily assess what a loss of credits could mean for the business. Rivian's disclosure also allows to separate out the software and services, or as I will call it throughout this presentation, the S&S, into the subcomponents, which is the services and other business, and the VW JV. So the service and other business is very similar to Tesla's services and other, where Tesla reflects all the vehicle maintenance, used vehicle sales, income from body repair, revenue from a charging network. Rivian also has a little proprietary charging network, and Rivian even has some insurance revenue. So it's quite comparable to Tesla's S&O segment, except of course scale significant. Rivian's scale is a fraction of Tesla's. And then the second important component is the VW JV revenue, and this part of the S&S segment is very different, because it's more comparable to a, let's call it, software line item, but we will discuss this in great detail much later in this presentation. So that gets us to the next key observation. On the summary page, you can see Rivian generated a gross loss of 1.2 billion in 2024, and the forecast, in line with management guidance, forecasts a modest gross profit for the full year of 2025. So this is exactly in line with what management said. Management didn't tell us how much, but they said modest gross profit, and I think 55 million would kind of fall ballpark into that range, depending on how you look at modest gross profit. The assumptions of the forecast, again, highly aligned with what management said, implying gross profit to grow to 740 million in 2026, and then significantly increase to almost 2.5 billion in 2027. However, gross profit is only relevant for assessing sort of the scale potential of a business, but to assess underlying profitability, you have to look further down into the P&L. And for that reason, it's crucial to review the OPEX line items. So operating expense line items include R&D expenses, SG&A. So R&D is all your research costs, and SG&A is basically everything else outside expenses for your production. But we'll cover this also in great detail much later. And you can see R&D expenses have been quite massive in Rivian's case. Rivian spent nearly 2 billion in R&D in 2023, in 2024, because frankly, Rivian was kind of running out of money before the VW investment and other things, and they had to scale back their ambitions and to spend 1.6 billion. The forecast optimistically assumes a very modest increase to 1.67 billion, with a further increase in 2026 and another increase in 2027. So the 2025 increase is driven, first of all, management's guidance. Management told us they expect underlying growth of R&D expenses in 2025. So the forecast is perfectly in line with this guidance. However, please note, this is a very modest increase, so the forecast might be optimistic on this point. Another important consideration is in terms of R&D expense growth that Rivian told us that all the associated expenses on Rivian's part in relation to the VW JV is booked in the R&D line, so it doesn't show up in cost of revenue. That's an important point to consider. So you have to assume, as Rivian does more and more work for VW to earn the deferred revenue, which we'll touch on later, there's incremental VW R&D expense in this line item. The next item is SG&A, and here the forecast actually deviates meaningfully from management guidance. Management also told us to expect a year-on-year increase in 2025, but you can see the forecast assumes a slight decrease, and the reason is the following. Rivian currently has meaningful excess capacities in its let's call it selling operations, and I think Rivian is a little bit sandbagging here, because this year they have been guiding, and we touch on this, for probably less than 51,000, and we'll discuss it later why. And this is actually less than what they sold in 2024. So they can sell this volume clearly on the current footprint, because the current footprint sold at volume in the last 2 years. When you look at 2023, they sold actually on a smaller footprint because there was some expansion, over 50,000 vehicles, slightly more in 2024, and hence I don't think it's reasonable to assume there's a significant expansion in that regard, because the business overall is not growing very much. And again, the primary expansion of the business takes place in the R&D line in relation to the JV. So this you might call like perhaps an aggressive or overly ambitious assumption. So this is some optimism bias here in this forecast. And I will touch later in this presentation on why I'm using an optimism bias throughout this forecast. So I stop here to keep these videos short and sweet. Video is almost 10 minutes now, so I hope to see you in the next one. Bye.